Hi everyone, this is the second video of financing decision chapter, and in this video what are we going to do is, in this video we are going to solve this problem of EBIT-EPS analysis, right? But before watching this video, make sure you have watched the previous video, because in the previous video we have seen the concept of this chapter, okay? What is meant by financing decision, what is meant by capital structure, and we have taken this example also, right? This example is very helpful to understand the concept of this chapter, right? And we have seen the format of EBIT-EPS analysis also. We have seen this format, okay? This format is also very important. You have to understand this format. Fine. So we have seen this format and we have discussed about the capital structure. What is meant by capital structure? Capital structure is the combination of long-term capitals, right? What are the different long-term sources of capital? That is debt, equity, preference. Yes, the finance manager can raise funds entirely from debt, or entirely from equity, or entirely from preference. Or what he can do is he can take a mix of these three, right? He can use all these three sources to raise the capital for the business, right? That is called capital structure, the combination of capitals. He can take 60% of capital from equity, 25% of capital from preference, and 15% capital from debentures, right? If he needs 40 crores, then he can take a proportion, okay? So that's what can happen. So the capital structure. So how the finance manager will decide how much to raise from each of these sources, right? So that is the main question over here. So he has to decide, the finance manager has to decide the best capital structure, right? There are n number of options he can do, right? 1% from equity, 99% from debentures, anything he can do. But the best capital structure, the best means, it is called here in this chapter, it is called optimum capital structure. It is called optimum capital structure. What is optimum capital structure? It is a capital structure, it is a combination of capitals, it is a combination of capital structure when the cost of capital is minimum, right? When the cost of capital is minimum and when the value of firm is maximized. The value of firm is maximized means there is maximization of equity shareholders' wealth. When will this happen? When will the wealth of equity shareholders will maximize? It will maximize when the earning per share or the market price per share is maximum, right? So that is the optimum capital structure, the best capital structure, where the cost of capital is minimum and there is maximum EPS, okay? These are the two conditions, fine, to decide the optimum capital structure. And the finance manager, how will he do this? He will do this by calculating the cost of capital, right? By analyzing each of the capital structures, right? Each of the capital structures, and by doing EBIT and EPS analysis to calculate EPS or MPS, okay, depending upon the question here, right? So this is what, so you have to understand this format, fine. So now we are going to solve this problem, right? So let's start. We are going to solve this problem, okay? So let's see the question. So make sure you have watched the previous video, because in that video we have discussed all this in very detail, right? So now let's start the question. Now let's start this problem, right? So first let's analyze this question. Let's try to understand what is said in the question, right? So here it is given, Axer Limited has 60,000 equity shares of rupees 10 each. The company wants to raise another 30 lakh rupees, fine. So here what we come to know is that this company already has 60,000 equity shares. It already has 60,000 equity shares and the face value of their share is rupees 10 each. So whatever shares they are going to issue in the capital structures, right, in their plans which they have given, the face value would be rupees 10. And here they have said already it has issued 60,000 equity shares, right? So this is very important, okay? Because here in this EBIT-EPS analysis problem, here we calculate at the last EPS, right? We start from EBIT and we reach to EPS, right? We calculate earning per share. While calculating earning per share, what is the formula? The formula is earning available to equity shareholders divided by number of equity shares. You see this? Number of equity shares. So the number of equity shares is very important, fine. So you see here, if you see the first plan, right, the first plan, that is all debentures carrying 10% interest, right? These are the different plans. How are they going to raise the funds? How is the finance manager is going to raise the funds? So which plan to select, that is the question. So in the first plan, if you see over here, all debentures carrying 10% interest. So what you will do, will you say that here no equity shares are being issued, right? No funds are being taken from equity, so the number of equity shares in the first plan is 0. Can you do that? You cannot do that. Why? Because the company already has 60,000 equity shares. So in the first plan, while calculating at the last, after you have got earning available to equity shareholders, in number of equity shares, you will take 60,000. You will not take 0, okay? You will take 60,000. You have to, because 60,000 equity shares are already there in the company. They have already issued 60,000 equity shares. Okay, fine. So this is what you have to pay attention to this. Fine, right? Then they have said the company wants to raise another 30 lakh rupees. So here we come to know that 60,000 equity shares are being already issued, right? And then the company is in need of 30 lakh rupees. And in the question, they have given us 4 different plans of raising 30 lakh rupees, right? The first plan is all debentures carrying 10% interest. All debentures carrying 10% interest. In the first plan, they have given that entire 30 lakhs are being raised from debentures by issuing debentures, right? All debentures 10%, 30 lakh rupees. Fine. And then the second plan, that is all equity. The entire fund, the entire 30 lakh rupees is raised from equity, right? All equity 30 lakh rupees. Fine. The face value would be 10 rupees, but this is not that much important, okay? Just the percentage of debentures is important, right? It is very important because we have to calculate the interest in EBIT, right? In this EBIT-EPS analysis, we have to deduct the interest. So we got to know the percentage, only then only we can calculate the interest, right? So it's very important. And then the third plan that they have given us is 20 lakh rupees in equity shares and rupees 10 lakh in debentures carrying 10% interest. Fine. So the third plan is 20 lakh in equity, 10 lakh in debentures. Yes, 10 lakh in debentures. So they are going to issue 2 lakh of equity shares, yeah, 2 lakh number of equity shares and 1 lakh number of debentures. Fine. I have taken 10 rupees as the face value of the debentures also, okay, and the equity shares also, but it doesn't matter, okay? Then we have got the fourth plan, that is 10 lakh in equity shares and 20 lakh in 10% preference shares, right? So the fourth plan is 10 lakh in equity and 20 lakh in preference. And the percentage of preference is very important because preference shareholders will get what? Preference shareholders will get dividend. We have to come to earning available to equity shareholders, so we have to deduct the preference dividend. We have to deduct the government tax, we have to deduct the interest, because from the operating profit, right, from the EBIT, from earning before interest and tax, we have to reach to earning available to equity shareholders. Then only we can calculate earning per share, right? So that is why I have to deduct all this, right? So the dividend of preference share is very important. You have to know the percentage. It will be given in the question. Don't worry, okay? You don't have to do anything. It will be given in the question. The interest rate, the dividend rate, everything will be given in the question. Fine. So you just have to deduct it, right? So this is the analysis of the question. And then they have said tax rate is 50%. Right? Tax rate is 50%. So you have to deduct the tax, right? We'll see how to do that. Fine, it's very simple. And then we have got calculate EPS if EBIT is 13 lakh 50, right? So first, what are you going to do? You are going to take 13 lakh 50, 13 lakh 50, 13 lakh 50, 13 lakh 50. You have to take 4 plans, right? So first, you will draw a table of EPS analysis. Fine. By taking 13 lakh 50 as your EBIT, and you will do all the calculation and then calculate the EPS. Fine. Then you will find the EPS when the EBIT is 13 lakh 50,000. But then again you have to make another table when EBIT is 10 lakh 80,000 and you have to do all the calculations. Okay. Then you will calculate the EPS with the EBIT of 10 lakh 80,000. Okay. We'll see how to do that. It's very simple, right? So let's solve this problem. Okay, you understood the question, right? We have got 4 different plans. The tax rate is 50%, and we have already got 60,000 equity shares, and we have to raise 30 lakhs from each of these plans, right? Each of these plans we are raising 30 lakhs funds only, but we have to choose which is the best capital structure. So that is why we had to do EBIT-EPS analysis and choose the best capital structure which has the maximum earning per share. So we have to analyze each of these capital structure by doing EBIT-EPS analysis. Fine. So let's solve this problem. It's very simple. Now let's solve the problem. See here. See how simple this problem is. See, the first thing that you have to do is you have to take the columns, right? See here, we have 4 different plans, isn't it? A, B, C, D. We have 4 different plans. So 4 columns of plans and 1 particulars column. So in total we have to take 5 columns. Simple here, right? So in the question they have said here, calculate EPS if EBIT is 13,50,000, right? So it's a simple thing. You have to start from EBIT, earning before interest and tax, right? But before that, you have to take each of the capital structure in these upper columns, right? You see this column, all debentures 10%, right? All debentures 10%. You are raising how much? You are raising 30 lakh rupees, right? So that is what? All debentures carrying 10% interest. The first plan, the first column. The second plan, second column, that is all equity rupees 30 lakhs. Again, from each of the plans, you are raising the same amount of fund that is needed by the business, that is 30 lakh rupees, isn't it? Yes, so all equity. So you chose here all equity. You wrote here all equity. Fine. And then the third plan is, what is the third plan? The third plan is 20 lakh in equity shares and 10 lakh in debentures. So 20 lakh in equity and 10 lakh in debentures, 10%, okay? Write the percentage also. Fine. And then the last plan, the fourth plan is 10 lakh in equity shares and 20 lakh in 10% preference shares, right? So 10 lakh in equity and 20 lakh in preference shares. Now, why are we writing this over here? See, that is because we are deducting interest and tax and preference dividend, right? We are deducting all these. So do you think we have to deduct interest from every column here? No. Why not? Because here, if you see the second column, here there are no debentures. You pay interest only on debentures, only on debt, right? Bonds and all, bonds, debentures. Here there are no debentures. Here there are no preference dividend. So you will not deduct preference dividend or interest from this column, right? So that is why you have to note this down properly. And the percentage also, you don't have to mess up the percentage. Sometime what will happen, sometime there will be two different kinds of preference. One will be 12%, one will be some other percent, right? So you have to take care. Fine. So that is what. So if you see, what we have done over here is, first we have to take EBIT. Fine. First thing that we have to do is we have to take EBIT, and EBIT will be common in all the columns. If you select this plan, this plan, this plan, or this plan, the EBIT will not be affected. Okay, EBIT will be same. There is no relation between that. Okay, so EBIT will be same. So 13,50,000, you have to start from that as given in the question, 13,50,000, and always mostly EBIT will be given in the question. So take the EBIT. Okay, 13,50,000, 13,50,000, 13,50,000, 13,50,000. Fine, you took that, and then you first thing that you have to do is you have to deduct the interest. You have to pay the debenture holders. Fine, EBIT. I is first, right? So remove I. Remove I. Okay, remove the interest. So interest, 10% interest on what? On the debentures. How much debentures you have raised, how much funds you have raised, on that you have to calculate the interest. So you have raised how much? 30 lakh rupees, right? 30 lakh rupees into 10%. So that is equal to how much? 3 lakh. 3 lakh is what? 3 lakh is the interest. So deduct the interest. So 13,50,000 minus 3 lakh is 10,50,000. Simple, right? From 13, if you subtract 3, that is 10. And then 50/50, that's the same. So 10,50,000. Understood? Right. Go on. So here, are there any debentures in the second plan? No debentures, so no interest will be deducted. Fine. And then go next. Then we have got here debentures. So deduct the interest. Here, only 10 lakh has been raised from debentures, right? Only 10 lakh. So on that 10 lakh only, we will calculate the interest. So 10 lakh, fine. We have got 10 lakh into 10% interest, that is equal to 1 lakh. So the interest in the third plan is 1 lakh. Understood? And the fourth plan, we have raised the capital from equity and preference, and we don't pay interest on equity, neither on preference shares, right? On preference shares, we give preference dividend, the fixed dividend, right? Right, that's the 10%, okay? Not 20%. It looks like 20%. It's not 20%. It is 10% as said in the question. Fine. It is 10%. Fine. So after doing that, and then you will get EBT, okay? You have to take as it is, this one, 13,50,000, 13,50,000, 13,50,000, 13,50,000. But here you have to subtract 13 minus 1 lakh, that is 12 lakh, and 50 as it is, right? 1250, right? 12,50,000. And then we have got tax. In the question it is mentioned tax rate is 50%. So deduct the tax. Simple. 10,50,000, right? 50% is the tax. So simple thing. See, 10,50,000, right? The EBT. On this only you have to calculate the tax, okay? The earning before tax. Fine. So 10,50,000 into 50%, the half of it, right? So that is equal to 5,25,000. So 5,25,000, deduct that. So if you deduct 50% from 10,50,000, right, then you will get 5,25,000 only as the answer, right? Isn't it? If you have 4 and if you take 50% of 4, you will get 2. And if you deduct 2, then the remaining is also 2. Isn't it? So it's very simple. So 50% of 13,50,000 is 675, and the answer will also be 675. And then 50% of 12,50,000 is 625, and the answer after deducting the tax will be 625, right? See here, I will show you once. 1250, right? 12,50,000 into 50%, that is equal to 6,25,000. And if you subtract 12,50,000, yeah, minus 6,25,000, you will get how much? 6,25,000. So that's it. Fine. So after deducting the tax, you will get it. Here also you deduct, okay? 13,50,000 minus 675, that is equal to 675 only. Understood? And then you will get earning after tax. After deducting the tax, before it was earning before tax. Now it is earning after tax. Simple. It's simple English, man. Okay, fine. And then you have got preference dividend. And do you have here in all the plans preference shares? Have you borrowed capital from preference shares? Yes? Have you? No, you haven't. You haven't borrowed in each of these plans. No, only in the fourth plan you have borrowed money from preference shareholders, right? So you have to deduct the preference dividend only in the fourth plan. It's simple, man. It's very simple, right? It's very simple, isn't it? So you deduct the preference dividend, and the preference dividend was given in the question as 10%, right? It was given as C, and 20 lakh in 10% preference shares, the fourth option, D option, right? The D capital structure. So 10% of what? Preference dividend. What most of the students do is they calculate 10% on 675 only, like tax. They think we have calculated 50% of tax on this only, so we'll calculate this also, this on this only. No, that's wrong. You have to calculate the percentage on the amount you have borrowed. Fine, amount you have taken. So here the 20 lakh capital is taken from preference shares. So 20 lakh into 10%, that is equal to 2 lakh. So 2 lakh is the dividend that you have to pay. So deduct the dividend. Fine, and then you will get the resulting figures. After deducting the I and then the T and then the dividend, interest, tax and dividend, you will get earning available to equity shareholders, right? Earning available to equity shareholders. Simple, right? So this is the earning, 5,25,000 as it is, 6,75,000 as it is, 6,25,000 as it is, because we haven't deducted anything, right? Isn't it? We haven't deducted anything. So it will be same only. And then here 6,75,000 minus 2 lakh, that is equal to 475. Isn't it? 6,75,000 minus 2 lakh, that is equal to 4,75,000. So 4,75,000 is the fourth plan's earning available to equity shareholders, right? You see this, right? So after getting this, after getting ES, earning available to equity shareholders, to calculate EPS, just divide it by the number of equity shares. Just divide it by the number of equity shares, then immediately you will get the EPS. See, for example, here 5,25,000, yeah, 5,25,000 divided by 60,000. Why 60,000? In the first plan there are no equity shares issued, but even though there are already 60,000 equity shares in the business, so that is why we have to divide by 60,000. Fine. And then in the next plan, see, 525,000 divided by 60,000, you get 8.75. Simple. And then here, if you can see here, we have issued how many equity shares in the second option? We have taken how much funds? We have taken 30 lakh funds from equity, and the face value of the equity was rupees 10, right, of each share. So 30 lakh divided by 10, that means we have issued 3 lakh equity shares. We have issued 3 lakh equity shares into 10, and we have raised 30 lakh capital, right? So you will say 3 lakh number of equity shares are there in this plan. But how much did I have taken? I have taken 3,60,000. Why is that? Why did I take 3,60,000 instead of only 3 lakh? That is because the same reason, that is there are already 60,000 equity shares in the business, so you have to include that. You have to consider that in each and every plan. In each and every plan, you have to consider whatever already that is there in the business. Fine. So here also we are issuing only how many equity shares? Only 2 lakh equity shares, and we are raising 20 lakh equity funds, right? So here 2 lakh are the equity shares that we are issuing in this plan, and the already issued equity shares are 60,000. So the number of equity shares in the third plan is 2,60,000, and here we are issuing in this plan 1 lakh equity shares, right, and raising the fund of 10 lakh from equity, right? But already we have got 60,000 equity shares, so 1 lakh now we are issuing, and 60,000 equity shares which are already there in the business, right? So it will be 160. Understood? We have to consider the shares which are already there in the business. Fine. And then we are going to divide. Simple. I will just show you this one, okay, because the time is not there, right? 6,25,000 divided by 2,60,000, that is equal to 2.403, right? So 2.403. Simple. So this is how you have to calculate. Understood? The simple thing, take columns of each plans, right, and the particulars column, start from EBIT, deduct interest, deduct tax, deduct preference dividend. Always calculate tax on the amount, the earning before tax, and the interest and the preference dividend on the amount which you have taken from the debentures or preference shareholders. Fine. And then at last you have to divide earning available to equity shareholders, divide by number of equity shares, you will get EPS, earning per share, and the maximum, the option which has the maximum earning per share, that option will be selected. Fine. So this is how you have to do this sum. Okay, simple, right? Right. Now let's see another one. Okay, and always the EBIT will be same, okay, in all the options. Fine. So now let's see the B option when EBIT is 10,80,000. Okay, in this we'll go very fast, okay, because we have no time over here. Now here is the B solution when EBIT is 10,80,000. See here, nothing has been changed except the EBIT. Okay, the proportion of the capital is same only. Okay, the options are same, entirely same. You see, just compare this. All debentures, yeah, all equity, everything is same, just the EBIT has changed. Fine. And as usual, you take EBIT in all the columns, right? In all the plans column, you take the EBIT, same EBIT. Fine. And then the first thing that you do is you deduct the interest. EBIT, the first thing is I, right? So deduct the interest. 10%, the same thing. 10% on what? The amount you have borrowed, right? Here you have borrowed 30 lakh from debentures, and you pay interest only to debenture holders, right? So if there are debentures in the plan, only then you will deduct. Fine. So on 30 lakh, 10% is 3 lakh, deduct that. And then here debenture is 10 lakh, so 10% on 10 lakh is 1 lakh, simple. And then after deducting the interest, you get EBT, earning before tax. Then you will deduct the tax, and you will calculate as usual tax on these amounts, earning before tax. Let's take example of this, 10,80,000, yeah. So 10,80,000 into 50%, that is how much? 5,40,000. So 5,40,000, and the answer also would be 5,40,000 if the tax rate is given as 50%. Okay, but now the corporate tax has changed, right? In India it has been changed, so you have to see in the exam what you get. Fine. And then you will get earning after tax, right? You will get earning after tax, and then you have to deduct the preference dividend. Fine. And the preference dividend will also be calculated on the amount of preference capital, right? That is 20 lakh, right? So 10% on 20 lakh, that is 2 lakh. Simple, deduct that. Then you will get as usual earning available to equity shareholder, yes, right? This is earning available to equity shareholders, and then you have got to divide this by number of equity shares. And as I said earlier that you have to consider the already issued equity shares in each and every plans, right? In each and every plans you have to consider the number of equity shares. Fine. And then you have to divide that, right? After dividing, you will get EPS, and the plan which has the maximum EPS, that plan will be selected. Simple, right? So this is what you have to do, right? And as I said earlier, you have to consider the already issued equity shares. Okay, whatever shares that you have already issued, you have to take that into consideration while calculating the number of equity shares. while calculating EPS, you got to know the number of equity shares, right? So you have to calculate number of equity shares. How many equity shares are there in each of these plans plus the already issued shares. Fine. So that is what you have to do. So here, what most of the students do, here they will take 0 and they will take here, like see, they will do like this, 3,90,000 divided by 0, because no equity shares are issued over here. They will think like that, all are debentures only, and they will just divide and they will get what? 0. That's wrong, man. That's completely wrong. So what you have to do, you have to consider the already issued shares. Fine. So this is what you have to do. It's very simple. You have to start with EBIT, deduct interest, okay, on the amounts borrowed, and then minus tax, yeah, and then minus preference dividend. And this is also very simple. You start from EBIT. After deducting I is gone, EBIT is there, and then after deducting the tax, from before tax it will become after tax, and then after deducting preference dividend, then all the obligations are met. All the obligations are met. Whatever money is left, that is the money of the real owners of the business. They are equity shareholders. So you have to check the wealth of equity shareholder, whether it is maximized or not, if you choose any of these plans, right? So you are doing this theoretically, right? So after dividing the number of equity shares, right, you will get EPS, and you have to compare the EPS, whichever is the highest, you have to select that plan. Fine. So this is how you have to do it. It's very simple, right? It is very simple. You just have to understand a little bit of this, right? That's all. And you have to write this properly, okay, because it is very important. Fine. So this is how you have to do it. Fine. It is very simple.